Deteriorating global sentiment and the drag on U.S. equities is consuming the market as the first quarter of 2018 comes to a close. And yet, despite some reason for optimism on talk of possible U.S.-China trade deals and diminished geopolitical risk as North Korea shows a willingness to sit down, none of this has managed to push the stock market back up towards record highs, with rallies all of a sudden aggressively sold into. The reaction is somewhat of a departure from the near-decade post-2008 crisis in which investors had been immune to negative risk, taking the market higher at every turn. And now we're seeing the opposite reaction, with the market selling off on negative risk and incapable of sustaining any recoveries on any good news that reduces such risk. We believe this is a function of the state of central bank policy and the onset of normalizations that should be responsible for triggering exactly this type of a reaction. Central banks had offered up immunity to downside risk in the world after the 2008 crisis, incentivizing excessive and reckless investment in equities in an effort to artificially prop up global sentiment. And so naturally, the reversal of this process is something that will have the opposite effect. We believe this is the way things will continue to be over the medium term as policy normalizations ramp up, and just like investors were wired to rally the market on anything positive while ignoring the negative over the past near decade of ultra accommodation, investors will now be wired to sell the market on any and all things negative while largely ignoring the positives as the policy normalization process pushes forward. To assign global tension on U.S. protectionism as the driver behind this latest slide would be somewhat incorrect in our view, with this serving as nothing more than a catalyst to a fated process that would and will come from something else if and once this risk is out of the way. Using the S&P 500 as our proxy, we believe the market should realistically be headed back down towards a retest of the 2015 high around 2140 in 2018, which would amount to a decline of some 25% off the record high from January. That's all for now.